Hello, in this video I want to very quickly show you how to calculate the free cash flows to equity for the financial statement that you've been building for your business. As you'll see, I'm starting with where I last left off. I've got revenue and all of the financials all the way down to the cash flow statements for the first 12 months. You'll see if you were to look at my reconciliation information that all my balance sheets tie. And the reason that I do this step now is that the free cash flows to equity is really just an extension, if you will, of the financial statements. And so it's easy to do this and then extend it out for multiple years. Whereas some of the other steps, it's better if you have all of the information before you do it. But if you remember from our prior discussions about free cash flow to equity, you basically start with the net income, and then you add back to that net income non-cash charges, depreciation, amortization, that sort of thing. You don't add back interest in this case because that is something that you actually paid out and it's not available to equity holders, and so that and taxes are sort of the other things that are in net income that we think about. You would add back cash flows from investing. We have cash flows from investing up at the top, and so you're adding those back. Now, the way to think about that again is that's money that you raised from selling things, assets, or whatever else, less money you spent on purchasing them. And so in our case, usually that's a negative number at the beginning. So you're going to add a negative number. We'll see how that goes. And then you're going to subtract off changes in non-cash working capital, and you're going to subtract that off in this case because if the working capital goes up, then that's money that is no longer available to equity. It has to stay in the business to fund the business. So it's really like a short-term asset. If working capital goes down, then that's money that is no longer needed in the business and can be freed up for the investors. And again, it's non-cash working capital, so it doesn't include the cash account. And then lastly, you're going to add net borrowing. So net borrowing is for long-term debt. We don't do short-term debt because that's in for current debt, I guess I should say, because that's in the working capital. But you're adding the amount you borrowed less any amounts that you paid back as principal. And I'm going to use a convention here where, depending on whether it's a positive or a negative, an add or a less, I'm just going to go ahead and put a sign. It's either going to have nothing or it's going to have a negative sign in front of it as I do it. And you'll see in a minute why hopefully that's useful. So for net income, I'll just go up and say, okay, let's go grab net income from the top. For non-cash charges, so that's equal to the depreciation in our case. So we'll go grab that back up at the top. For cash flow from investing, we're going to go grab that amount from right here. It is exactly this. So since we already have it in the cash flow statement, it made it easier on us. Changes in non-cash working capital, we have that up here as well. So we're going to go ahead and grab that. And here we're going to do equals a minus because it's a less over here. And so we're just going to grab it right there. Okay, and then we're going to add back net borrowing. And that is equal to the amount that we've raised from long-term debt minus the principal that we've paid on long-term debt. So we got all of that. Now I'm going to do one other thing. Going to go ahead and change the format on this just a little bit. I like, particularly in the free cash flows to equity, so that it sort of pops out at you to be able to see better what's a positive and what's a negative value. And so I selected a currency format. I'm going to go under more currency formats, and I'm going to use the color format. And so what that's going to do, you'll see, is it's going to make negative numbers be red and positive numbers be black. And that just helps us to kind of walk through the logic on that. I'm also going to shrink down the decimals on this. We just don't need it. So now, because I've put the signs in front of everything, right? No negative sign in front of any of these, but I put the negative in front of this. We can get to free cash flows by simply going equals the sum of all these values. Okay. And again, I'm going to apply the same formatting to that. And you'll see that it's red, indicating that we have negative free cash flows. Here's the logic on that. Of course, we have no income. We have no depreciation at this point. We're in month 0. But the way to think about it is that we have money that we got from borrowing, and we know we got that up here. We have money that we got from short-term borrowing, so that was a long-term. We now have short-term, and that showed up in working capital, and in fact, that's the amount that we borrowed as current debt. And so the combination of those two, if we go over and look, is $277,500. We used that money to buy the assets, right? It wasn't quite enough. We needed to put in an extra $30,500. Now, I just want to make this point to you. We actually put in more than $30,500, but we don't count the amount that we've contributed as equity. We account the amount that's available to take back out, from what we've done. And so it's not really, this isn't a measure of whether or not I have put money into the company. It's a measure of whether or not the company has generated any money for me as an equity holder. And at this point, I'm down $30,500. So yes, I've got 92.7. I'm down 30,500. And so you would expect that I've got 62.2 left, and that's what you show up there. So anyway, that's kind of the logic behind that. I am going to go ahead and, as you guys know, I like to do a little bit of the color coding, so I'm going to do that. Now it's just a question of dragging this whole thing to the right for the 12 months and making sure it still makes sense. So again, nothing really happens in the first couple of months. Now we start having some income. Clearly we haven't made any other expenditures, but we're starting to use a little bit more working capital here. It's being consumed. And if you were to go back up and look, you would see that that's being consumed by inventories that we're starting to add. So we're adding inventory a little bit each month as the thing grows. But other than that, basically from a cash flow standpoint, we're building cash flows. So we started out at minus 30,050. If I sum all of these together, you'll see down here it's about 75,000. So by the end of the year, if we were to do sort of a cumulatively, where are we in terms of free cash flows, we're positive. And then right here at the end, we go negative again. We go negative because we have both an interest payment that knocks down our net income, right? Of course, we recover some of that back from depreciation, amortization, but we also have that we make we pay off the short-term debt, and so that's a cash outflow. Working capital goes down. Goes up, because we've spent that non-cash working capital. And net borrowing goes down because we make a principal payment on the long-term debt. You can see that up here as well, where we make the principal payment, right? So all of this makes sense, and lo and behold, what it basically says is that now this is just month 12. Remember, these are flows, so it's not cumulative. And so in month 12, we have a negative. So if we were to run across all of those and do just a sum, we're ignoring time value of money right now, you've really only generated $5,466 towards free cash flow to equity over the first 12 months. But a lot of times people will look at that and they'll say, well, that's not bad, that's a good thing, because what it basically means is it's positive. So by the time we get to the end of the first 12 months, I've generated enough free cash flow to equity so that I actually have more value of equity than I started out with. And so, generally speaking, people consider that to be a good thing. Anyway, that's the entire free cash flow to equity for the first 12 months. Is pretty simple. I just wanted to do it in small chunks here so that you guys can see how that goes. Hope that's useful. Bye.